But we're focusing on the IT sector right now. I'm quite excited about this conversation. CLSA has come out with a detailed report on the IT sector outlook and Q3 preview. The report signals caution after the recent rally, with muted growth ahead and selective downgrades. HCL Tech and Tech MC ratings cut, while Persistent and Coforge remain top picks. We'll dive into what's driving the calls on this with Sumit Jain, Senior Research Analyst at CLSA India. Sumit, thank you so much for coming in. And, IT stocks took quite a tumble the day after your report was out as well. Just let's understand why you think some of the major names or the larger names are going to see pain.
Well, I guess clearly the broader discretionary demand has not revived in the markets. And obviously, December quarter is seasonally a weak quarter in terms of furloughs and holidays. And I guess other than the BFSI vertical, we are not actually seeing any strength in the other verticals, particularly for the large cap players. And that's where, based on our discussion with the company managements going into the silent periods, we could sense that there is further constant currency growth estimate cuts for most of the large cap players. And that's where, the sector did relatively well, I would say, in the last couple of months, on the back of expectation that the US economy will remain resilient next year going into midterm elections. And that's where, we could see that HCL is, trading at a premium to Infosys and TCS. And obviously, going forward for the next 2 quarters, they are weaker than the December quarter. So that's where we have downgraded HCL. On Tech Mahindra, we still have a outperform rating, but I guess the near quarter is going to be weak. The conversion of order book to revenue has been slightly muted for the last couple of quarters. And then in terms of the margin expansion ramp up from here for the next 4 to 5 quarters, the ask rate is pretty high for them to achieve their FY27 vision. And that to some extent is in the consensus estimates as well as in the price. So that's where, we removed it from our high conviction list, but still remains one of the outperform rated stock, and along with Infosys, the top 2 picks in the large cap space.
Interesting. Okay. Sumit, morning. Alex here. I specifically want to ask you about Coforge because this acquisition has led to a bit of a divided opinion. Some have actually said that it is accretive, and despite the price that is being paid, it's actually going to be quite positive for the counter. And you've actually maintained an outperform, and you've hiked your target price. Are you in the camp that says that it is positive, and why do you say that?
No, clearly, I think, we see a lot of complementarity and synergies out of Encora for the Coforge combined entity. Now, if you look at the geography cut or industry vertical cut or the capability cut, almost on all 3 fronts, there are a lot of cross synergies between Coforge as well as Encora. So clearly, if you look at what management highlighted, Encora is largely focusing on Midwest and the western part of US, whereas Coforge is concentrated more of the eastern part of US. In terms of industry verticals, high tech and healthcare will become a scaled vertical going forward. And Encora is more around AI engineering, cloud, and data. And I guess this is what you need going forward in the next 5 to 10 years, when the AI applications will be up and running in almost all the devices we are using, as well as on desktop. So we clearly see that there will be a lot of synergies, both on revenues as well as on cost. Maybe, in terms of the price they have paid, we clearly see that to be slightly stretched. I think that's sort of one concern, but overall, we believe Coforge will continue to deliver a mid-teens kind of earning growth going forward. And I think the recent correction in the stock because of this large acquisition and potential fundraise, which the company is still not very sure of, it gives a great opportunity to, buy into a great quality asset.
Right. Sumit, good morning. Hiral on this side. It's a very interesting time where you've come out and said that this is a time where you should reduce your position in the sector, where majority of the fund managers that we've spoken to, at least I have spoken to, have come out and said that probably 2026 is going to be a year where IT will be one of the top performing sectors as well. Now, it really contradicts both the scenarios, right? At this point in time, what is it that will make you change your stance to a buy or start adding positions when it comes to IT? What are those factors that you will be watching out for?
Yeah, no, firstly, I think in terms of the contradictory statement, just want to clarify the money that we are talking about to take away from IT sector is more to do with the couple of downgrades we have done. We are still outperform rated on TCS, on Infosys. Even Tech Mahindra is still outperform, but not a high conviction outperform. So on a relative basis, we are recommending within the sector to reduce the positions. But yes, for the overall IT sector, our India strategist is quite positive on IT because of potential India-US trade deal resolution, plus the rate sensitive sectors as well as consumption story. So in that sense, CLSA as a house is still positive on the IT sector. But within IT, of course, we are recommending to reduce positions in certain names. But yeah, I think there are a lot of triggers for the sector going ahead in terms of the US macro, the tariff resolution of US with various countries, the H-1B visa rhetoric fading away, and the expectation. I think the most important point is whether this sector will see earnings upgrades going forward. And there we believe the downside risk to street estimates for FY27, which is building in a 4 to 6 or 5 to 7% kind of constant currency growth, the downside risk is fairly low to those estimates. So yeah, for the overall sector, we are still quite constructive as a house.
Just trying to understand some of the factors you've talked about, Smith, and wanted to come into them. In terms of the India-US trade deal, arguably, the tariffs, etc., and everything that's happened in the last 12 months did not impact IT directly in any real way. Is there truly an upside if there is a resolution on the trade deal? And if so, in what substantive manner would we actually see it coming through? Because the issue seemed to be what's happening in the US economy, discretionary spends, etc., which don't seem to be going away.
No, I think from the earnings standpoint, you are right. It doesn't really change the needle. But from the sentiment standpoint, from the narrative standpoint for export-driven sectors out of India, I think the valuations do take a knock whenever these geopolitics play out. We have seen when H-1B visa fee was hiked in September, there was a significant cut to the valuations of the sector. And I think over the last year, we have seen whenever the India-US trade deal resolution or otherwise is in the news, the Indian IT sector valuations do react to it. And that's where we believe, that the India-US trade deal resolution would be sentimentally positive for the entire export basket out of India. Maybe for IT sector, it doesn't impact the earnings directly.
Just to round things off, you've spoken and we have spoken primarily about the large caps. But if you were to extend it to the entire space, then what would the pecking order be from your perspective?
No, I think great question, and that's where we are more positive on the mid-cap names like Persistent, Coforge, LTI, Mindtree. So we have like almost 18-20% upside on LTI, Mindtree, and almost 40 to 45% upside on Coforge and Persistent. Where if you look at Persistent, Coforge, I think for the last 5 to 7 years, they have been consistently delivering a strong double-digit earning growth and a sort of de-linked to macro, created their own niche and delivering almost 3 to 4% kind of a sequential constant currency growth every quarter. So I guess both those companies have their unique strengths, but I think given the revenue size they have of $1.5 to $2.5 billion, they are in a very sweet spot to capitalize on the AI tailwind going forward, where for the large cap players, they are probably facing revenue deflation on the legacy business. So we have seen time and again, whenever these technology cycles every decade play out, the mid-cap players who are executing well, they are actually able to repivot their business towards the new technologies much more easily. And LTI Mindtree, I guess, under the newly appointed CEO, has shown signs of improvement. They have won 4 large deals in the space of 6 to 8 months and are now guiding for a high single to a low double-digit growth in the next 3 to 6 months. So, of course, LTI and Mindtree, before the merger, both of them had performed brilliantly well. And I guess now, under the stable management, they are again recouping those losses and able to consistently deliver probably a high single to low double-digit kind of an earnings growth.
Interesting. I'm sure we're going to speak soon enough. The earnings season kicks off next week, and I'm going to be very keen to read what you think about those numbers. Thanks so much for joining us today.